So thank you very much for those kind words, Kampamba, earlier. You know, when you were highlighting how old we are and you highlighted 20, you know, if I was standing for public office, I'll simply say, I think I take it. Because I think the younger you are, the more chances you have of continuing your terms. But obviously, these are markets. The older you are, the more trusted you become. Because the markets thrive on trust. So I appreciate so much for those introductory remarks. And I must be able to say thank you very much also to FNB. I think we've been on this path for a very long time trying to get, partners to come alongside us to help us to get to see how we can then develop our markets. I think our financial markets, if we have to have them deeper, the partnership has to be very mutual and very deliberate. Otherwise, we then lose, the entire scope of what we're trying to do. So I think we must be able to thank, FNB for having come through. At least we're now making the rightful strides in terms of how then do we work together. When the debt market is struggling, we must be able to pronounce the equity market. And I think that's the reason why we're even here today. Because on one end is crying, the other end must then be able to provide the solutions to help us then to get to see which way are we moving in terms of going forward. So I must be able to say thank you very much on behalf of the LuSE for having come through for this particular partnership, and we look forward as we get to have this partnership started today. We'll be having these regular quarterly reviews together. That will give us a perspective of both what we've just seen now from Chileshe's commentary and to what we're seeing both on the debt as well as on the equity side. Because we then want every one of us to be able to make informed decisions, because that's the reason why we're here as market players, to be able to do that. So in terms of the presentation we're going to be doing today, we're just looking at how the market has fared from January to date. Obviously to date being July, because I've not closed yet the month of August. So we'll pretty much just be speaking to the fundamentals as they sit now as at the close of the month of July. So about us, I think it's very important, and like I already said earlier, the LuSE is the main exchange in Zambia. If we have to raise capital in terms of equity, there's only one place that you can then look towards, and that's basically where the exchange sits. And being the main exchange in Zambia, we're very proud to be able to say, look, for the many, listed companies that we already have on the board now, that already gives us a very leading indicator of just what sort of platform we've created and which direction we're taking even as an exchange. So the essence of why the exchange was created, diversification of some of these SOEs into private hands, but also like the agenda was outlined earlier, to drive a very strong corporate governance, a culture within our markets. And by you participating in the market, you're helping us then to drive that particular agenda very aggressively. The other essence, obviously, is to allow a lot of Zambian, investors be very key players within the private sector. And I think we provide a very unique platform to that end. So the LuSE has a very unique, positioning. And even as we're sitting today, standing in front of you today, it helps us to give you that sort of, comfort. So the presentation outline, we'll look at the market performance. We'll look at the peer market performance. How have we fared compared to the rest of the region? And then we'll look at the outlook as earlier on commented. So we want to look at these three facets to be, key ingredients to what we're looking at from where we've been from January to date. So moving on to the next slide. The next slide just merely gives you a sense in terms of how the market capitalization has fared. The market capitalization is basically the measure, of how the exchange is weighted in terms of its, its total value. So if you look at from where we're coming from in January to where we are closing in July, we moved up, in terms of market cap from about, I think, the lows of about 90 or 89 billion. We now close the month of July at 118 billion. Now, if you do your growth in terms of percentums, you then be able to realize that just on market capitalization, we're already way above, some of the, your minimal benchmarks, because we're above 30% in terms of growth of our market cap. If you have to look at, the last 12 months in terms of how we fare on our market capitalization, 53% is our market cap, on a year-to-date, on an annual basis. But again, that just gives you a sense in terms of just how the markets are really performing, and quite very aggressively. And I think, like was earlier on commented on by Chileshe, if on one end the debt market is struggling, we can see now the reality on the competitive end. On the equity market, we're seeing the rally in terms of how these share prices are moving. And that's reflective of this market cap. If we move on to the next slide just gives you now a comparative. I think Chileshe did speak quite very ably around the economic fundamentals, and also how the GDP projections are going to look like, over the next, few years. Now, if we have to look at the value of the exchange and how it compares to the entire economy, that measure we are showing you there is quite a very unique indicator, because then it shows you the concentration of the capital markets in terms of the entire sizing of our economy. So within the local currency terms, our market cap to GDP was sitting about 24%, but if we bring in the dollarization aspect, comparing our dollar, market cap to our actual US dollar GDP, we are now sitting slightly about 15%. Now, this is a very emotional statistic for all of us, because the conversations of us developing our markets and even our economy cannot go beyond those particular statistics. Because if we're talking anything about equity market, the comparative has to be how much of that capital is sitting on the public exchange. And I think these are very useful statistics even for foreign direct investors, because when they're coming into the market, the first thing they'll ask is how much is sitting on your exchange. And I think looking at a number like 24% in local currency and 15 in USD, it already gives you a lot of, emotional sort of attributes as to what else we need to be able to do as a market to drive that particular number up. If I had time to be able to show you the other slides, it actually shows you how very competitive, this particular metric is. In Malawi, just across here, they're sitting north of 27% in US dollar terms, in terms of the market cap to GDP. And if you have to look at our country, our neighboring country, Namibia, they are sitting north of about 280%. Same for South Africa. Botswana is sitting almost about 100% of their capitalization to GDP. So our ambition, obviously, even as Zambia, is that particular trigger of our USD market cap to GDP to be able to move way beyond 25% within the next, few years. So we have a lot of work to do, but the comfort is we're heading in the right direction. As seen earlier, the market cap is moving up. So that gives us a very good sense in terms of the direction that we're taking. Now, how do we then, size ourselves across this, market capitalization for the exchange? Now, this slide just gives you also a bit of an insight in terms of where is the concentration of this capital. If we have to look at the exchange, where is the bigger chunk of it sitting? If you look at what we're seeing there, the bigger chunk of our market capitalization is skewed towards retail trading. And that obviously gives you a sense in terms of the dynamics of our market. We are mostly a retail market. So again, we're seeing quite a huge concentration of our stocks, sitting in the retail trading area. Interesting enough, just like was presented earlier, the energy sector presents a very huge opportunity for us. And we can see even the current market capitalization is quite very heavily concentrated in the energy sector. Moving on to the other one, we see financial, if you can go back. Moving on to the next sector, which is heavily concentrated, financial services. And I think that's the reason why we're here together with FNB, because we can see just how very close in terms of concentration of capital they have within the market. The rest of them is in agri. I think the president has been quite very hard on the aspect of trying to develop agriculture, and we can see just the sizing of capital that is sitting in agri. Let's move on to the next slide. So now, this slide also gives you a bit of appreciation in terms of how the markets are fared. I think when the introductions were being made by Nalu, she wanted to get to help us to see how has the exchange performed year to date. And what we're showing you there is just basically an answer that should stick as a takeaway in terms of how has exchange performed. So in terms of the all share index, which is basically a reflection of how prices have moved across the exchange, the graph you're seeing there gives you a sense in terms of the direction. So at least it shows you a positive and upward trend. So helping us then to get to see that the momentum that is being built within the market is an upward one, but also a very positive one to get to help us to appreciate the rally that we're seeing coming through as more investors are coming to the market. So if you have to compare from where we're coming from in Jan to where we're sitting in July, we are up in terms of the index by 33.7%. Now, that's also a very emotive sort of index or a metric, because for those of you who are investing, that becomes a comparative benchmark. Because if you have to look at your fixed income market, your fixed income market is sitting about max about 25, 27%, if you have to go the longer end of the curve. But now what we're saying is up to July, the equity market has already beaten that index in terms of performance. And that already gives you a very good sense in terms of the opportunities that are sitting on the exchange. So if some of us are sitting on the fence, already that gives you a cue in terms of how fast you must be able to rally towards the market, because you're missing out on opportunity. So in terms of the gains, we're sitting at about 33.7% as of July. Now to even push it further, as of yesterday, I was just asking the team before we came, in terms of where we're sitting, we are now sitting about 39.7%, in terms of gains for the market. And again, I think that deserves a clap, I'm also sure. And I think those are things that, ladies and gentlemen, we need to be very close at heart with, because the performance of the exchange cannot go beyond some of these particular, indicators. And we want us to be able to have these emotions deep-seated, because that also galvanizes the sort of conversations we're having today. Is there opportunity? Yes, there's an opportunity. And we can clearly see in terms of how the numbers are sticking out. If we move on to the next slide, the next slide again gives you a sense, again, in terms of some of the unique dynamics on the market. So in as much as we are saying, look, we've got 33% up on the tick in terms of how the market performed, where is the performance concentrated? So in terms of turnover, we saw the biggest turnover coming through on Pamosi, and primarily because Pamosi was doing an equity buyout of over 90% of their stake, and thereafter they went into a mandatory offer. So what you're seeing in terms of turnover, we saw a huge traffic flow, on that particular equity by virtue of those particular dynamics that were prevailing on the stock. But what is interesting is there any other business sort of stocks that were moving during the course of the period? We have got CEC, performing quite very well in terms of turnover. We've got Airtel, we've got Chilanga, and we've got Standard Chartered, and the rest of them are grouped as other. So again, the graph, the chart you're seeing there just gives you a very good reflection in terms of how is activity, of the top 5? How is it performing, and are we seeing, increased load of activity on many other counters that we have on the market? Because this has got a very driving, emotion as we get to see into our presentation of what we need to do, both as an exchange and the banks, but also even as a market, collectively. What can we do to be able to drive more names on that particular, graph? Moving on to the next slide. The next slide, again, is quite a very, emotive slide, because it gives you a reflection of the behavior of clients, what we have on our market. Now, the biggest chunk of our activity from Jan to date in July, the bigger chunk of that particular activity was driven by foreign, portfolio players. And again, this is a very leading indicator that most of us must be able to look into, because if this is our market and we want to drive this market to where we want it to be, we must be able to see those 10 and 13 starting now to subdue the 77%. But obviously, the reason why we're sitting at 77% is because of what we saw in Pamosi. A lot of traffic flow was coming through because of foreign participation. But what is also interesting for me is the split between the retail, local retail and local institutions. And I think that particular positioning of 10% being retail and 13% being institutional is also a very unique leading indicator. Because now what we're seeing on the market, and these are the behaviors, is that we're seeing a lot of retail participation coming through to the equity market. And I think that is what we're seeing now as being a unique, rally of clients coming to the market. And now they are getting in almost a similar amounts of values as we are seeing from the institutional players. And I think that is a very telling indicator in terms of how the dynamics are changing, on the market. Once upon a time, you'd have maybe about 1% or 2% sitting under retail, but now in terms of turnover, you're almost like neck to neck. And again, that helps us to get to appreciate the dynamics on the ground, and it also helps us to appreciate that more people are now getting more acquainted with the markets, but we just have to drive more, more volumes in terms of turnover from these retail participants. Moving on to the next slide. So how do we then fare compared to the rest of the markets in Africa? Obviously, we're not going to compare ourselves S&P or NASDAQ or, mention them. Let's get close to home. So how are we faring in terms of our returns compared to the rest of the African region? So now, if you look at the rest of, the selected countries in Africa, we are actually sitting at number 2, comfortably, And if you have to look at the only country that has beaten us in terms of performance is Ghana. Ghana in local currency, they're sitting at about, 39%. We are just under, Ghana at 37%. Assuming something has happened in Ghana over the last 1 week, I'll then be saying I've toppled over Ghana, I'm sitting at 39%, and probably Ghana has come down. But obviously the markets are quite very bullish lately, and we'll obviously be able to see a lot of, notches up for Ghana going for, over the next few weeks from July. So in terms of how we are faring, we are doing comparatively very well. We're sitting in at 7.2%. And again, that's quite a very, unique positioning. If you have to look at some of the stronger markets, obviously if you have to look at the JSE sitting in South Africa, they're sitting in at about 8.7%. Compared to the nature of their market and the sizing of their liquidity, you probably may expect that to be almost like the normal trend. But obviously our markets are small and we're just getting a lot of, participation in the market. a rally towards 37% is something that is very unique and common for us. Last year, August, we closed about 48%. Our anticipation this year is going to probably close in within the same regions, by the end of the year. But this particular slide just drives home the point that if we are not yet active in the market, the market is already ready for you. We're missing the opportunity as investors. But most importantly, as institutional funders, we also have got a very unique play, to be able to support the market, to be able to provide more in terms of the capital market sizing. Now, the next slide is just basically now a mirror, a reflection of the same returns, but now going back into foreign currency. And again, we're sitting on a very comfortable second slot. And again, this is also a very telling, slide. Because in as much as we have seen a lot of, economies struggling, recovering from, from last year going into this year, we should remain quite very resilient in terms of our performance. In foreign currency, we're sitting on the second slot. And again, you can see, Ghana, which was beating us on local currency, has slid downwards, quite very poorly performed. Obviously, those are the dynamics around the FX, rates, and how the movements is going around the FX margins. But on our end, because our rate has been somewhat stable, so in as much as we're talking about local currency at 37%, in terms of the depreciation of our local currency to dollar, we're not very much, poor. We are still just about 400 basis points, below what we had recorded in local currency. So again, this helps you to appreciate that if you have got, access to your foreign portfolio participants, this is a time for you to be able to lead them on, the Zambian market. There's no better time than now because you can clearly see the market is performing, above expectation, and getting a return in dollar cents at 34% is quite a very unique, investment for most of these guys. Let's move on to the next slide. So now, what is the outlook, having had and posted all these, interesting, gains year to date? What are we looking at going forward? So I think listening through to Chileshe speak around the macroeconomic sort of forecast, it somewhat summarized what we had here in terms of our outlook as well from the exchange point of view. So one of the few, elements we're looking at is we're still seeing a momentum still being built up, for the rest of the year, probably even going into next year. This momentum of, increased share prices and even the rally that we're seeing coming to the market should be built up in the momentum that we have already observed this far. We also must be able to say that obviously if you have to compare our market sizing to the GDP, we still think we are relatively undervalued. So again, that gives you, reason to believe that the momentum that we're seeing on the share price gains can be sustained at least for the next medium term. With respect to the IPOs, I think when I got in, the first thing I got to be asked is, what's the next IPO? But I think that's a typical, question that, as an exchange, we are literally trying to get to answer. The beauty about it and the comfort that we can give to you in this room is that the IPO pipeline is healthy. We have got selected names that are, being lined up. We hope we can get one closing in before the end of the year. That will probably give us a bit of hype, at least for the market, for the last, few years that we have had, the last one being Zafico. So I think going into this year, hopefully before the end of the year, we can have one, IPO, which we are hoping can come even next month or the month after. So that will give us a bit of a new life in terms of, the direction of the markets. But what is also very interesting when we're talking about the pipeline of IPOs is the aspect of how many people are now coming to the exchange to be able to knock to raise funding. And I think the point that was raised earlier, if the debt is struggling or is quite very crippling, where are the opportunities for these individuals that are looking for capital? So if you have to look at the number of, queries we've had in terms of listings, and even the ones that we're currently working on to make sure these are piped up for listing, that particular, pipeline is quite very healthy. And we're very comfortable that all things being equal, we must be able to get to see some 2 or 3 names within a space of the next 24 months. With respect to the positive economic outlook, I think it was very ably stressed in the earlier presentation. The very fact that we could be struggling here and there does not, defeat the point that the outlook remains positive. And for us, from where we're sitting, the very fact that the economy is moving forward also gives us leverage to be able to grow our markets, and we're looking at that to be an opportunity for us. And then lastly, sustainability remains quite very topical, not only for us, but even for the boards. And most of us here, obviously, are being sensitized, for the need for us to be able to participate and support sustainability. And from where we're sitting as an exchange, we're seeing a lot of, interest for projects that are being listed, for either sustainability reasons or indeed those that are indeed trying to convert, into a sustainable sort of projects. And some of these are both on the debt side and also on the equity side. And we're very happy, obviously, from where we're sitting as an exchange, because then the platform is working to enable the market. It's also working to enable the environment to such an extent that you can then be able to pipe these activities on the exchange. So in closing, I must be able to say that liquidity remains quite very topical. Most of you probably could be now asking, yeah, we have said all those things that you have said, but now let's get back to liquidity. Yes, liquidity has been the biggest problem that we have had in the market. And if we have to look at the going forward, the only way we can improve liquidity is a simple realization that this is going to be a medium to long-term, project that we have to deal with. And primarily because there are several enablers that we have to be able to put in place. Some of which have to be, you as institutional funders must be able to come to market, and readily so. And I think if you have to look at the step that FNB has taken, it's already a very leading sort of step. Now we know that we can then enable the market to be more liquid. So all of us who are sitting in our different vantage points, be it as private equity players, be it as banks, be it as asset managers, or indeed pension funds, this becomes quite a very leading sort of slide, because now the aspect of us driving liquidity has to be very collective. It cannot be done just by the exchange. And I think that is quite a very emotional appeal we're making also, because if we have to drive a different narrative around liquidity, it has to be very collective. And I think that's the reason why we're talking about, let's have deep pockets within our institutional funds. Let's also have deep pockets within these sort of asset management firms to be able to drive these funds, to the market. The other things that obviously should remain quite very unique to enable the market to be more liquid are aspects to do with regulation. And I think we're not sleeping as an exchange, because we do play a dual mandate of regulating the listed companies that are trading, but most importantly also to be able to excite companies to come to market. So we're also not sleeping on that aspect of regulation. We have seen our regulator in the room also. We are also not sleeping, and keeping a very close eye in terms of what's happening on the exchange. If you can go back. So if you look at the other enablers that we have there, the legal environment has to be very consistent to what we want, and also the consistent flow of listings that we said earlier. If the pipeline is healthy, can we then get to see some of these names crystallize into actual listings sooner than later? So over and above, in closing, I must be able to say that we have performed relatively very well as a capital markets, and we are very happy that to where we are to date, the returns are sitting positive and not for the fixed income market. That already gives us an incentive for us to be able to drive emotions around investors, but most importantly also it drives a very useful, emotional appeal to prospective issuers to then be able to look in this direction to be able to raise money. I think when the debt market is struggling, it's not all gloom and doom. I think we've got an opportunity on the equity market, and I think that's the reason why this partnership with FNB becomes quite very useful for us, because then the discussion around what other alternatives can then be very close at hand. So with that said, thank you very much for your attention. We definitely want to take any questions afterwards.